Thank you for your time in joining us as we walk through this business case example. One thing at Advanced CFO is we have a passion for helping business owners. We know that business ownership, entrepreneurship is not for the faint-hearted, that you're constantly inundated with problems every day. And we have an extremely experienced and competent team that we can bring to help you with these types of challenges. You could see from this business model the impact that we were able to gain from shifting from more of a compliance mindset within the accounting and finance functions to more of a strategic mindset. And this is what we try to help to educate people on, and we try to get people to where they can be more proactive on finances. And within our company, we have CFO level resources, and we define CFO level resources as those is that function that deals with the more strategic and forward-looking and how to interpret financial statements. We have controller level resources. These controllers are extremely skilled at providing accurate financial statements in a timely manner, talking about month-end close procedures, and they can work within your existing staff to be able to achieve the desired objectives. And then we also have accountant level resources that do more of the bookkeeping. Each one of these resources bill out at different rates on a fractional basis. And so the notion is that we can come in whatever situation that you need us in. If you want us to support your existing staff, we can do that. If you want us to replace key functions, we can do that on a temporary basis until you're at a point where you need to hire a full-time resource in that capacity. We can do all of this. And so if you have any questions, please reach out to us. We want to see you be successful. And through our experience, we've generated a network of key financial professionals that we can rely on, from banking contacts where we can source different lending facilities, to investor contacts in the private equity and VC community, to insurance, to marketing professionals. Most of us here at Advanced CFO, depending on our level of experience, many of us have owned our own businesses. We've seen the challenges that you've been through. We want to be able to help you get through this, and we want to see your business succeed. So please reach out to us. Thanks for joining us. Okay, now we're going to talk a little bit about the balance sheet. So over 2019, we were able to enter all of the balance sheets in on a month-to-month basis. And why this is interesting and important, and we're able to derive meaningful information about it, is because from a month-to-month we can start to see trends. And again, the balance sheet has to do with health of the business, whereas the income statement has to do with the performance of the business. And so under certain scenarios, you could be running a very good business from a P&L perspective. But on the balance sheet, if you don't have the balance sheet right, if you don't have the health of the company right, it could really imperil the company. You can have too much debt on the company, and you see this a lot on Wall Street, where during low interest rate environments, a lot of companies go out and they just load themselves full of debt, and that works. But once interest rates start to rise, their debt cost on the profit and loss statements start to rise as well, and all of a sudden those consistent margins that everybody was so excited about, now all of a sudden they start to evaporate, and you start to get a lot of margin pressure, and that can actually take the company down. And so when you look at the balance sheet, you look at a couple things. One, you look at cash. So cash is really important. You can have a great profitable company, but if you don't have the cash to maintain operations, to pay payroll, to pay obligations, if you're not anticipating those, then you're in a tough spot. You have to go, you become desperate, and typically when you're desperate for cash, it's really hard to get cash. And so you can kind of understand cash cycles and understand, like, when are you going to be tight on cash, anticipate those, and make sure you have the appropriate credit lines in place, or you raise some investor money to get through those tight spots. And so you always want to keep an eye on cash. And this is one thing that most business owners, without having any knowledge of this kind of more advanced analysis that we've done, this is one thing intuitively they kind of keep an eye on, is their cash. They usually look at their sales, they look at their profit, and they look at their cash. But what we try to do is stay ahead of those metrics and also extract more meaningful information from some of the other categories, so that every decision is more driven by data and intelligence, financial statement intelligence. And so we have our cash categories grouped here, and you can see over time that we have some seasonality. November's a big month for us, and so we book a lot of cash that month. We typically do pretty well. We got a little leaner in April, and as we saw from the P&L, we started off the year a little tough, where we had a number of consecutive operating losses, but then we had our big May, and then that kind of got us out of that problem. And then we have what we call our current assets, and as we talked about before, current asset is defined as anything you should be able to convert into cash within 1 year. Now we compare our current assets to our current liabilities. And these are things like our accounts payable, our credit card debt, anything that kind of has, that we need to be able to clear off within a year. And so there's a ratio that we can run called a current ratio. And this tells us how, if we were to pay off our current liabilities, how many times over could we do it with our current assets? Now you see we started off at a 1.68, which is actually pretty good. That means that we could pay off our current liabilities with our current assets 1.6 times over. And then you can see we actually gained a pretty strong liquidity measure. Even during our low cash month in April, we still could pay off our current liabilities 5 times over. Why is that? It's because we were just really prudent with managing those current liabilities, and our current liabilities actually declined, and so we were able to have some discipline in keeping up with our payables and that sort of thing. Now, if your current ratio falls below 1, that means you have some liquidity problems, and that you need to either go raise cash in the near term to be able to feel like you have the cash necessary to satisfy your near-term obligations. And if your current ratio is too high, and this is actually starts to be a really cash-rich business. When you start to get to 5.58, you start to wonder, maybe that's too much of a current ratio. Maybe there's another opportunity to deploy our cash more efficiently. And so you can have those conversations. Maybe you raise some debt, and maybe you want to pay down some debt with some of that cash. And that'll lower your current ratio, but it will also it'll lower your overall debt to assets ratio, which is an important leverage measure as well. Maybe you want to start to experiment with some of that cash and say, hey, we have enough cash now, maybe we want to experiment some marketing dollars and see that if we increase it by X%, what impact that has on revenue. And now that you have a firm grasp of the business model, the competency of the business model, the relationships within the business model, now you can start to experiment with cash and say, what if we hire more people here? What if we do something there? And then you can start to keep track of it, and then you can start to optimize the business model. So that's the importance of the current ratio. Fixed assets. This isn't a fixed asset heavy business. But we do track, all the fixed assets in the business and depreciation and what the book value of those fixed assets are. And then we have some non-current assets that have some receivables from some owners and security deposits and that sort of thing. As we look at the liabilities, we've talked through the current liabilities. We have some bank loans, and so this is what we track. We say we've got $437,000 in bank loans, and you go back up to cash and say here we had an owner's distribution. So this is always a really fun event when you actually get to the point where owners can take cash out of the business. That's what ultimately owners are in business to do. And so when you are cash rich, that's another opportunity for cash. You say, well, let's take cash out of the business. But then you start to say, well, do we want to pay down some of our debt? And that's an opportunity there. And here what we've decided to do is wait until we get into a couple months in 2020 to see how we start out the year. If you remember the prior year in this business case, we started off the business really slowly, and so we don't want to extinguish lines if we think we might need them, because again, when you need cash, it's always tough to get cash. And so what we're going to do is we're going to sit on this, and we're going to keep these bank loans in place until we kind of see maybe midway through 2020 to see how we're doing. We can generate some more ratios. This is a debt to assets ratio. We can see we kind of hover, before we did that owner's distribution, we were only leveraged 56.65%, which is a really good debt to asset ratio. And what we figured is, hey, owners, let's allow you to take a distribution and bring this up to the debt to assets ratio to 72%. And that's still a really healthy ratio. But what happens is we had a lot of equity in the company, and we decided, hey, let's take out some of that equity and still have a strong equity position. Now, one thing from a ratio analysis perspective is when we start to ask the question, what's the most effective metric to value your business? And most people would instinctively say profitability. And profitability is certainly important. But the DuPont ratio framework is a framework that was pioneered by the DuPont company back in the early 1900s when they started to acquire a lot of different types of companies. And they started to ask the question, how do we evaluate these different industries we're in? What metrics can we use to really understand how valuable these businesses are? And what they settled on is a metric called return on equity. And what return on equity measures is for every dollar you put in the company as an owner or a shareholder, how much money do you get back? And that's for an investor, for an owner, that's really what's more important to you, even more important than profitability. Because you can be highly profitable, but you might not have a really high return on equity. And so these are the components of return on equity, and these are some ratios that you can use to measure each component. One is profitability. And so here are some ratios that we can use. We've talked about gross profit margin. We've talked about an operating profit ratio. There's also a PE ratio, which is the expected future earnings growth rate. But then there's this other component, and this is for inventory-based businesses, and this is efficiencies. We look at our inventory turnover. We look at number of days sales in inventory. We look at your accounts receivable inventory or turnover. We look at average collection period. We look at fixed asset turnover. We can look at sales per employee. All these measure efficiency. So there's something called an operating cycle, which measures at what point do you pay for an inventory item, and what point do you actually collect on the sale of that inventory item. And so to the degree that operating cycle is 6 months and you can move it to 3 months, that increases efficiency because you're taking that same dollar and you're turning it twice as fast. And so all things being equal with profitability, if you were able to increase efficiency, that increases your return on equity. And then we talk about leverage, and we've talked about some of these liquidity measures. There's the current ratio. How are you doing on near-term liquidity? There's the debt ratio. We talked about that. This, if you're highly leveraged, if you're over 100%, that means that you have more liabilities than you have assets, and that's a problem. And so you need to work hard to bring that into line. You have your debt to equity ratio, your assets to equity ratio, your times interest earned. And what that measures is your operating profit, and you divide that by your annual interest expenses. And that basically says, with your profit, how many times over can you pay your interest expenses? And that helps to give you a comfort level just with the level of interest expense you have on the books on a P&L perspective. And to the degree that becomes disproportionate, you have to start asking questions about how you need to recapitalize your debt and make that more efficient. Maybe you bring in more equity and you reduce your debt. And so those are the components of the DuPont ratio framework. The return on equity equals profitability times efficiency times leverage. Now, what happens now that we have this analysis pretty well dialed in, we feel like we have a good grasp of the business model, what you will see is opportunities to track what we would call KPIs, key performance indicators. And so we have a tab here that's a KPI dashboard. And we're going to improve upon this over time. But there's a couple of really interesting things on this dashboard. A lot of this stuff is the stuff we talked about: revenue, gross profit margin, operating expenses as a percent of sales, operating profit. But this is a metric right here, these two metrics that we decided that we wanted to track. And what we realized in the business model was that we were getting a certain amount of shipping income. And that was income that we were charging our customers at checkout to ship an item. Then we had an outbound shipping expense. And there was a big difference between that. We were starting off the year and we were losing almost $32,000, or 20.46% of sales, which is huge, just because we weren't charging our customers what it cost us to ship inventory. And so we started to concentrate on this. And you can see that throughout the year, as we concentrated on that, we started to narrow it. And we had some initiatives to where we started to say, like, okay, let's make sure that we try to pass all of our shipping costs onto our customers. And we narrowed that. And then in December, we saw that balloon up again. So it's always a constant fight, but you can see where that opportunity is. And so over the year, we were able to narrow that to 3.28% of sales. And we lost $132,000 on the year on that metric, but we did much better than we would have otherwise. And so that's a conversation we're going to continue to have into 2020. So this is the business case. Now that we kind of achieve a competent business model, competent forecast, competent KPIs, a framework to evaluate metrics within the company and how everything works together, and we've achieved a level of accuracy in the financial statements. The other thing that we want to make sure that we do is achieve a level of timeliness in producing those financial statements, because when the data becomes dated, it's not as useful. And so, you get accuracy, you get timeliness, and then what we do with a client is we establish a regular cadence to where we come in and we review this model with them. We talk about budgets versus actuals, we talk about variance, we talk about opportunities for growth, we talk about challenges, and we highlight areas that merit those types of conversations. Thank you.